Do you want to learn the secrets of trading? The truth is, too many investors know the struggles of trading. Now let's find out what worked and what didn't with their personality, as these successful investors share their trading journey with us.
Hello, everyone, and welcome to another episode of A Trader's Journey. It's my pleasure to bring you Dennis Dick, CFA, prop trader, and market structure analyst for Bright Trading. Dennis, how are you today?
Doing good. I'm doing good. I even shaved for you. Oh, no, just kidding. I didn't. I was going to actually shave for this interview, and I was like, well, I do the pre-market prep show all the time, and I always look scruffy. So I was like, I didn't want people to not recognize me, so I actually didn't shave for the interview for that reason.
That's okay. I didn't either, so we're on the same page. Not a problem. All right, so let's go ahead and get started, and let's start right at the beginning. How would you say you got started in trading? Was it something that you started when you were young?
University. So had traded my parents' money in university for a little while. Be my second year university, just retail. This would have been back to 1996, so we're going back quite a ways. And I was just trading retail, just playing around with my parents' money for a couple of years. And then I graduated from University of Windsor in 1999. And I started right away. I had a friend that was at this prop trading firm called Bright Trading. And I went and checked it out like 4 days after I graduated university because I loved trading. I was just doing it on the side, retail, doing a trade here, a trade there, 3, 4, 5, maybe 10 trades a week. Very light, just light retail trading. But I was having some success with it. Probably the reason I was having success with it looking back is that we were in a huge bull market. So I was just benefiting from an up tape and being primarily a long trader. And everything you touch kind of turns to gold when the market's going straight up. So I got out of university. I right away I knew I wanted to be a trader because I loved doing that on the side through university. So I went, checked out the Bright Trading office in Detroit, and met Joel Alconin, who I do the show with. He was the manager there at the Bright Trading office. And I literally just like, this is for me. There was like 20 traders in there. They've got, the Squawk Box going, which is a live broadcast from the trading floor. They've got, everything I was looking at, I was like, wow, this is really cool. So I funded my account, and 5 days later, I was started at Bright Trading. May 3rd, I think 1999 was when I started.
Wow, what an incredible journey. Where along your journey did arbitrage trading come in? And just
okay,
viewers,
well, let's
explain a little bit about your trading and what arbitrage trading consists of.
Well, what I can tell you is if you're in this business for the long haul, and I've been professionally trading with Bright Trading for 21 years, if you're in this, you have to continuously adapt your strategies because what works today will not work tomorrow. So when I first started Bright Trading, I didn't really know what I was doing. I came from retail. I looked at charts, right? That's what everybody does when they come from retail. They're looking at charts. They're like, oh, nice cup and handle pattern. Maybe this is going to go. Maybe there's a setup. Maybe this stock's trending up. Maybe it's going to go. Maybe this stock's going to break out. What I realized quickly was that just trading on technical analysis wasn't very consistent. And I wanted to, learn from the traders in there. And the nice thing about being in a trading office and being at Bright Trading, back in 1999, half of the traders that were in that office came from the floor. So you were learning so many different types of strategies. I mean, my mentor, Joel Alconin, known from Premarket Prep, was a floor trader. So you start learning about relationships. And Bright Trading is very big on relationships, what you can get into arbitrage, stat arb, different strategies, but everything is related to something else. And that's what I was like, wow, this makes sense, that the market's going to move this and this is going to happen. So what I started to do was like look for different relationships and trade those. And that's really where it evolves into arbitrage. So back in 1999, you didn't have high frequency trading, at least not to the extreme nature that we do today. So you could literally profit from pricing inefficiencies, like mispricings in the market. I can remember back to like 2002, I was trading risk arbitrage, and I was doing JP Morgan versus Chase Manhattan. And JP Morgan had bought Chase Manhattan, and the ratio was 3.7 to 1. So basically, you could say it was roughly 4 to 1. So what would happen is you would have news happen and stocks start moving. Well, JP Morgan would blast off. It was a $170 stock, then it would blast off $6. And Chase Manhattan's sitting there and hasn't moved yet. Well, you can short the JP Morgan up 6, buy the Chase Manhattan flat, and within 30 seconds, that arbitrage relationship comes back in. But back then, like in 2000, 2001, 2002, we kind of were like the high frequency traders. So we were the quickest, we were the fastest. Like it was actually when I started at Bright Trading in 1999, if you were trading a stock that was listed on the New York Stock Exchange, you had to send all your orders to the floor. There wasn't all these other, ECN networks. They were just getting started. So the majority of the orders, 80 to 90%, were actually executed on the floor through the specialist on the floor. So I would send an order, to say buy shares of IBM, and that order would go to the specialist on the floor who would actually have to hit the order with his finger on the post and then give me the fill back. And that whole process took 8 seconds. So it was literally 8 seconds between when I sent the order till I knew I had confirmation back. Well, that was still a huge edge because markets would move. You'd have like a 215 number where the Fed comes out with a Fed announcement, stocks blast off. I would just go at and try to lift a whole bunch of offers, and then like, am I going to get it? I'm going to get it. And then 8 seconds comes back and you see all the stocks you got, and then you're shorting the SPY against it and hedging yourself out. So you can see quickly, I was looking, to be fastest on the news. So even today, I specialize in news trading. I was trading news and headlines back then as well. But what arbitrage is, it's just looking at relationships and how the stocks are related to each other. I mean, risk arbitrage is merger arbitrage. That's a pure relationship. But you can also look at different things. There's share class arbitrage, like Viacom A versus Viacom B, which is Viacom C now. There's so many different relationships in the market. And what I'm trying to do is extract alpha by exploiting the relative inefficiencies within those relationships.
That's absolutely amazing. That's not a strategy that I've ever practiced before, but that sounds
well, it's difficult
awesome
to do from a retail perspective too, because you've got to obviously be quick. You've got to have systems. Right. It can be done. And a lot of the stuff is done by high frequency traders now too. So don't think, oh yeah, I'm going to beat the bots. Yeah. I mean, it's different now. So we've evolved, and I talked a little bit about evolution of trading in the first question you asked, but I've evolved over the years. And what we've evolved from is straight up arbitrage is difficult to compete with the high frequency trading guys. They're really fast. So we've kind of evolved into statistical arbitrage, where we look for quantitative edges that have been proven to work over time. And they're not as black and white, they're more gray. And what I mean by that is it's not as easy to program an algorithm to take advantage of those relationships. And anything that you can't program an algorithm into is an edge where a human being can have for a long, long time. So like, for instance, Spencer Israel, just the pure sympathy play. And just today, Spencer Israel, EV got taken over by Morgan Stanley. So Eaton Vance taken over by Morgan Stanley. That's a risk arb that I will probably play. The relationship's 0.5833. I'll probably put that one into works tomorrow and I'll start trading that. But there was plays off of this today. So the first thing I'm like, what are the sympathy plays? And actually Spencer, who's on the show as well, spit out a few to us. And he said IVZ, JHG, Ben, which is Templeton. And I was able to buy some IVZ at the open today. It opened kind of low and it went straight up. So I was able to take advantage of a low open that hadn't fully priced in the fact that, hey, this is an asset manager that actually might, lift as well with an asset manager getting purchased today. So you can see the relationship-based trade there where I bought IVZ because EV got taken over.
Amazing. Amazing. How would you say that your trading experience has changed the way that you view markets?
The number one thing after 21 years is you realize that the markets are all rigged. It's all rigged. And it's just a matter of working around when everything is trying to work against you. And what I mean by rigged is there's multitudes of reasons. I mean, it's kind of rigged to the upside because every time the market drops, the Fed, does something to defend the markets and bring it back up. Trump does the same thing. But even the little micro infrastructure, and you mentioned off the bat how I'm a market structure analyst, so I analyze the plumbing of the market. And the plumbing of the market is rigged as well. It always has been. It used to be back in the day, the market makers on NASDAQ, we'd say they let you in, but they won't let you out. So you'd actually go to lift an offer. So I'll take you back to like 1999. It wasn't instantaneous execution, and the market makers had an out, and they had 15 seconds, believe it or not. You could say the stock was offered, and it'd be like Merrill offering the stock at like $25.50. I could lift the offer, like say, okay, I'm buying it at $25.50. The market maker had 15 seconds to decide whether they wanted to change their mind. That was, the way the markets were designed back then. So I would like try to lift the offer, and they say, no, no, you're on the bid now. We don't want to sell to you at that point. And the stock price would move up. So that was how it was rigged kind of back then. And now it's kind of been changed where it's rigged in different ways. The spread is rigged. You have off-exchange market makers that buy orders from Robinhood, from all your retail brokerages, and they trade directly against those orders, which eliminates the need for speed because they're getting first dibs to trade against an uninformed order. So I sit on the offer at like 25.5, and somebody goes to lift me from Robinhood 25.5. It's highly unlikely that that person sending the order from Robinhood is going to be able to lift my offer, because what happens is that off-exchange market maker gets in the middle of it, because that order isn't routed to me directly. It is routed first to an off-exchange market maker, and they decide, do I want to take the other side of this order or not? If they think the order is on the wrong side of the market, they execute against it. If they think it's on the right side of the market, they send it through to the exchange for execution. So what happens is the flow on the order flow on the exchange gets more toxic. It's like all informed orders there. So long story short, I don't want to get into the plumbing. I don't want to get into the market structure. What has happened is that they have monopolized the spread. So basically, it's very difficult to just sit on the bid and sit on the offer and get filled. You typically only get filled on your bid when the market's rolling through you, and you typically only get filled on the offer when the market is coming up through you. So what I have adapted to adapt to that rigged market, which it really is I no longer provide liquidity, I take liquidity. And what does that mean? It means that I lift the offer or I hit the bid myself. I don't sit there and put my bid out there and then let everybody else work that bid against me, because what your posted bid is really doing, it's insurance for a high frequency trader or an off exchange market maker to say, hey, I'm going to lean on his bid, and if the market goes south, I'm going to hit it. And if the market, goes higher, I'm going to make money. So what happens is your bid doesn't get filled when it's working in your direction, but it gets filled when it's blowing through you. So it's better to actually take the offer or hit the bid.
Okay, so with that as the backdrop, because there was a lot there, what lessons do you think every trader needs to learn in order to have success?
Number one is discipline. It's the only thing that matters. If you don't have discipline, you will not succeed in this business. And what do I mean by that? You have to be able to take losers. If you are trading and you're sitting there and saying, I'm down, a point in this. Well, I don't want to lose $1, so I'm going to wait for it to come back, and then I'm going to sell it. 90% of the time, it probably comes back, but eventually you're going to be stuck in those 10%ers that don't come back, and those stocks continue to erode, continue to take away your capital, and eventually what happens is you'll be stuck with a portfolio of losers. So if you're not willing to cut your losers quickly, your losers will turn to bigger losers, and you will end up, probably eventually maybe even blowing out your account. So the number one key to success in this business is cutting your losers quickly and letting your winners run a little bit. So the discipline to admit that you're wrong. Think about it as a casino. If you have an edge, if the casino has an edge of 2%, let's say they're 52%, that you have a probability of 52% making money. That means you're going to be wrong on 48% of your trades, even if you have an edge, like a good edge. And that, you may not necessarily even have an edge. So if you're always holding on to your losers, that means 48% of your trades are likely to move against you, and you're cutting those winners quickly. The math adds up that in the long run, you're going to probably lose money because you can't be right on all of your trades.
Yeah,
so it's all discipline.
I would agree with that completely. I tell people all the time, the biggest thing that you can do is protect your capital every single day.
Play with the house's money.
And one of the hardest things for people to do is admit when they're wrong. So being able to do that, absolutely a huge and crucial skill.
I'm wrong every day. Like on any given day, I probably make, and if I was going back to when I was doing a lot of algorithmic trading, and we could talk about that too, back in the early 2000s, I was doing a lot of algorithmic trading. It wouldn't be absurd for me to make 1,000 trades in a day. And I wasn't full high frequency. I was just using some algorithms. And like now I probably make anywhere from 50 to 200 trades a day. So you're going to have trades. You're going to be wrong on lots of these trades. There's no way you're going to be 50 for 50 today or 100 for 100. It's not going to happen. So you've just got to manage those. And people always say, sometimes I'll have an open, and I specialize in trading the open. I get filled on 50 stocks at the open. How do you manage 50 stocks as a human being? You know what I do? I go to the losers and I work myself out of the losers. This isn't working. This isn't working. This isn't working. And then I kind of just forget about the winners. The winners, I don't have to worry about that right now. I'm not losing money on that. And that could actually make me money. So what I'm naturally doing is cutting those losers and letting the winners ride, which is actually counter to what a lot of people do, because a lot of people are quick to take their winners, but they hold on to their losers. So I'm actually taking the opposite side of that trade, which has proven to be successful for me for 21 years.
And that's what a great explanation. I see that every day. So next here, how has being a parent changed your trading style? What can you recommend to those out there that have young children that want to trade full time?
I mean, I traded in an office for a number of years, a bright trading office. I now trade from home. And this isn't just pandemic. I moved from home. I trade from home back, I think it was 2013 or 2014. So I've been trading from home for a number of years now. Obviously, you've got to be able to separate it. So if your kids are running around the house, you've got to be able to basically shut your door and separate yourself from, from having the kids in the background. But, there's also, and obviously kids of all ages, you can figure out different, consumer trends from your kids as well. And this is talking to maybe, the investors more, the longer term swing traders, where they're like, okay, well, what's hot right now? Well, I mean, if you're looking at, different toys and you got young kids, what's my kid want? What are they looking at? Mm-hmm. Or, you can look at, other consumer trends where if you have older kids, what's my teenagers? What are they on? Are they on Snapchat? Are they on Instagram? What are they gravitating to? Are they on Pinterest still? Are they moving on to TikTok here, which is apparently what they're doing right now? So, I mean, that helps with trading to a certain extent because it keeps you connected with the real world. And, I think there's a big edge in figuring out where consumer trends are going. I know Mitch is specialized in the story. We talk about the story all the time on the show. If you can get ahead of the story and figure out where the money is going to naturally rotate to, there's big money in that.
Yeah, I think that's really good advice. I tell people, trade what you know. That seems to be the safest way to do it.
Exactly. And kids keep you connected with the real world. I mean, it's easy as a trader to just get stuck in your little, tunnel vision, really, looking at what you do. But I mean, trying to keep, and that's why I do the pre-market show too. I mean, the pre-market prep show helps me to connect with other people. It gives me different trading ideas and allows me to not have that tunnel vision of my own strategies, but to, get different strategies and different ideas and different consumer trends from other people. You can see what are people talking about in the chat? What are people talking about on Twitter? Looking and using those social media aspects can help you to get ahead of the next trade.
Yeah, absolutely. I couldn't agree with you more there. So if you could start all over again, where would you focus your energy on day one?
I think I did it a pretty good way. I often joke if I could redo it all again, I think I'd do it the same way, because you have to learn how to lose in the beginning. So if you come into a market and you're making money right away, you don't learn anything from your winning trades. You learn from your losing trades.
Is that I never ask my clients to judge me on my winners. I ask them to judge me on my losers because I have so few.
And anybody who started trading in this COVID environment in April has been a beneficiary of one of the biggest bull runs in 4 months that we've ever seen. So we obviously had the washout in February and March, and then we bottomed late March, and we've been straight up ever since. So traders need, and I was the same way. I can relate to that because I started in 1996 and we had a huge bull run from 1996 to 2000. So, I was benefiting from the uptape as well. So I think I do it the same way because you've got to learn how to lose. So one thing is, I think I really lucked out because I started at Bright Trading in 1999 and I realized quickly that I knew nothing. When I started in trading 96, 97, 98, I thought I was a trading genius. I mean, I was making money on all these different trades, and I was like, wow, I'm really good at this. And then you come into Bright Trading, you're like, oh my goodness, I didn't realize, but I know nothing. I was just benefiting from an up market. And what I was able to quickly learn was, how to short stocks, how to make money on two sides, how to hedge your trading, how to, the whole, floor trader aspect of it all, order flow, reading the tape, understanding different types of strategies that are involved in this, and, not just benefiting from an up market. So I lucked out because I started in 1999, we were still in the bull run. And I think if I would have still been trading retail in 2000, I probably would have got crushed. But I had already adapted before the tech bubble burst in 2000. I had a year of adaptation to understand both sides of the market. And then by the year 2000, I was very prepared for the market crash. And the market NASDAQ went from 5,100 to 1,100. The NASDAQ fell 81% over the next year. So, you know, this was a serious, serious crash. I mean, think about that. If you had $1 million worth of tech stocks, you now got 200 grand only with it. So, I mean, and that's investing in the index. There were individual stocks that were $200-300 a share that went to zero.
Yeah.
So, you know, if I would have been a primary long only trader, I would have got crushed in those years. And you know what the difference was? 2001 was one of my best trading years ever, because I learned how to short stocks. I learned how to make money from trading pricing inefficiencies. And I wasn't, you know, losing money. I wasn't not only losing money during the down market, I was actually making money during the down market because I was taking advantage of those pricing inefficiencies. And when the VIX pops, it's always good for an inefficiency trader because you have relative mispricings. They might be small in a normal stabilized market, but when you get a crazy market, like even back to March and COVID, these relationships blow out. But if you're still respecting these relationships, it's just more money. So if they're out here, you make this. If they're out here, you make that gap. So there's just more money to be made in a volatile market for an inefficiency trader.
Yeah, I love that answer because when I first started, one of my friends who had been trading for a number of years told me, Ryan, before you learn how to make money, you need to learn how to lose money. And I didn't understand what he said at first until I actually got into it. And then I learned real quick exactly what I meant. So it's great to hear you say the same thing.
Well, I'll give you an example too. So my first week of bright trading, I somehow made money that week just by pure luck. My second week, I think it was the second day of my second week, the Tuesday, I lost, I think I was on 18 consecutive trades, I lost money. And I'm like, man, I suck at this. Like, think about the odds of that. You flip a coin 18 times and comes up with tails. Because really, I mean, you can bet long or you can bet short, right? So it's 50-50. So, but, you know, here you are, you bet 18 times and you lose on 18 consecutive trades. It's like, wow, I'm not doing very well at this. So I learned quickly, though, what I was doing wrong. I kept learning from those losing trades. And for the first 6 months of bright trading, I lost money. But then I started to stabilize, and then I started to come around. And by the end of the first year, I was actually back in the green, and I had made a little bit of money. And then the next year, my earnings and my P&L exploded, and I've continued to make money ever since. I haven't had a losing year since I started in 1999.
Awesome. Do you remember your first trade and what happened?
Retail. I do remember it. It was Net Nanny software back in 1996, and this was one of those internet, like, you know, email pump and dumps. Really is probably what it was. But I was getting, you know, the person who had this was pumping this out, and I was buying this. I was like, oh, you know, this is going, you know, this is a really good story here, and I didn't realize this is kind of like a pump and dump scam, and I'm on the wrong side of it. So, you know, I quickly, you know, learned the hard way that, hey, you know, even the markets we were saying it was rigged back then too, because I was getting in this email about this Net Nanny software stock, and it was probably, looking back at it, just a pump and dump scam, where they buy the stock up and then they promote it out there to like 40,000 or 50,000 or maybe even more than that, maybe 400,000 people, hoping a few people buy it and then it continues higher. I was one of the suckers that was buying the stock. And I made money off it, off a little bit, but then, you know, obviously, you know, the pump stops and the stock starts to deteriorate, and you realize quickly it's like, oh, I've been had. So I can remember that because there was a lot of dirty stuff back in 96, 97, like little email scams like that. There still is today, but I think back then people maybe weren't as cognizant to it, so they probably worked a lot better, these scams. So, I mean, you've got to be very careful when you just get a tip in your email inbox from somebody. You know, you just got to be careful with it. So I do remember that because I had that trade, and it ended up working out, you know, actually but I got out just in time. But at the same time, I could have lost a lot of money because I was actually on the wrong side of a pump and dump scam that I didn't even know what that was back then.
It's amazing. Some things never change.
Yeah, some things never change, and you still see stuff like this.
We're always hearing conflicting thoughts on this topic. How has your experience gone with pre-market or after-hours trading?
Okay, so I have adapted my trading over the years, like I said, and I was always just primarily an intraday trader. Start at 9:30, end the day at 4 o'clock. That went on till about 2010. So about the first 11 years of my trading, I traded 9:30 to 4, and that was it. Then I started to realize that, you know, I was playing around a little bit in the pre-market and after hours, and I started to realize, like, wow, I'm into inefficiencies. There's a lot of inefficiencies pre-market and after hours. So I was kind of built for that because I was extracting inefficiencies in the intraday, but there's way more inefficiencies after hours. I mean, stuff's all over. The market's way less liquid. I mean, you think a stock's liquid, but every stock's liquid after hours. So, and then I realized, oh, news is coming out after hours and these stocks are moving. So I switched my focus from like intraday scalping to more news focused trading, like basically specializing in trading headlines. And I know there's people out there who believe you can't trade headlines. I'll tell you, they're wrong, because I have successfully traded headlines for a decade, and a lot of people can do this. And I know other traders that trade headlines. If you're quick, you can do it for sure. There's a lot of money to be made in just looking at headlines and trading headlines. And the one thing about pre-market and after hours trading, it's about understanding it's a completely different environment. And there's what I would call booby traps everywhere. So you've got, market makers out there that's saying, oh yeah, I'll set up $1 and sell this thing up $1, when there's no news on it. So you just got to be careful like that. You kind of try to avoid, people who might be more informed than you and taking the wrong offer, and you're like, uh-oh, that person knew something. You can tell right away. And not that they knew inside information, but that maybe they knew a headline that you weren't aware of yet. Mm-hmm. So like the headline might be out there, but it's impossible to monitor everything. So you might miss something. So, you got to be quick, and you got to be really quick to take your losers too, pre-market after hours. But it's a completely different style of trading. I don't suggest anybody start with pre-market after hours trading. You've got to kind of be seasoned to do it. Obviously the liquidity is a lot less. You can get caught on the wrong trade. You can lose a lot of money. I mean, I've been caught on the wrong trade, and had a stock taken over on me before. And you go short the stock. You think, oh, okay, this looks good. And then 5 minutes later, the stock gets taken over, and it's like, oh man, somebody's bidding that up. They knew something. I shorted to them, and now the stock's taken over, and I'm losing like 30%. I mean, so one thing always in your trading too, just go on another tangent, is stay diversified in your trading strategies, meaning don't like put all your eggs in one basket. Don't go on margin 100% one stock, because you could get on the wrong side of a trade and it could really move against you. I never put really more than 3 to 5% of my trading capital in any position. So stay diversified, not only in your long-term investing portfolio, but in your trading portfolio.
Yeah, I think that's really good advice. I, for one, don't trade pre-market because I've been on the wrong side of trades too many times.
Oh, it's hard.
So,
I mean,
yeah, absolutely it is.
Yeah, like I'm very good at identifying news now. Like you'll see if there's one bid just spinning up there, maybe they don't know anything, but you see multiple bids and they're like hopping each other. Oh, there's something happening, and then you see, oh, there's the headline. But sometimes the headlines are hard to find. I mean, sometimes it might just be an article that was posted somewhere, like a Barron's article comes out on a stock, and that's going to move it. And, you can't monitor, sure, you can monitor the press releases through Benzinga Pro, but you can't monitor every single, there's maybe somebody that's well followed just said something on Twitter. Maybe Trump just tweeted something. I mean, Regeneron yesterday starts taking off. Well, if you're not paying attention, you don't know the reason Regeneron's taking off. Well, the president is pumping it. On a video that he just released. So, you can get the news, but you've got to be, cognizant that, you've got to be able to identify that, I see in multiple bidders here coming up for something. That's news. When you see the multiples jumping each other, that's news. So I would just, even if I didn't know the headline, I can tell just by the trading action that that's news. And if I don't know the news, I don't want to trade that then, because I don't want to be the uninformed trader that's making a trading decision on information that I don't know about.
Yeah, good point. Good point. And then, so lastly here, the majority of traders struggle to manage long-term and short-term investments. How do you get around this mental hurdle?
I suck at that too. That's so hard to do. So hard to do. And I struggle with it. And as, a short-term scalper, short-term inefficiency trader, where I'm going for nickels and dimes, I mean, I struggle in the long-term investing portfolio. The more I look at it, the worse I do. The best thing to do is have another account and don't look at it. And every time I look at, I try to not log into it sometimes for weeks on end, but you kind of know what stocks you own too. So it makes it difficult as well. So, the best things that I've done is almost the Warren Buffett approach. My best long-term stocks are stocks that I bought like a decade ago and I didn't look at, like Google and like Apple and like MasterCard. Like I have these are the biggest stocks in my long-term investment portfolio. And why are they, the biggest winners in my long-term investment portfolio? And why? It's because I'm not looking at them. I'm not going in there and actively selling and trading them. And over the long run, if you pick good companies, they do grow. So, kind of the Warren Buffett approach there. But it's difficult. As a trader, you're into the short term so much that I start what I say is trading my long-term portfolio too much, where I'm like, oh, I think I can get out of this. And sometimes you get out at a good price, but then you forget to get back in. And then, the thing takes off without you. And you're like, wow, like PayPal is a good example. I had PayPal from an eBay spinoff that I bought back in like 2011. And I was looking at it, and Apple Pay was coming out. I was like, oh, competition's getting pretty intense for these guys. I'm like, you know what? I'm just going to sell it. I sold my PayPal stock at like $40, and it's like $200 today. So I would have been a lot better not to worry about the short-term headlines that, with Apple Pay, there was some headline on Apple Pay that spooked me. And I'm like, oh, they're going to start, it's hammering on PayPal. And maybe they did for a day, but then, it turns around and PayPal obviously built themselves an awesome business. And we know Apple Pay didn't turn into much at all. But at that time, it looked scary. And I ended up selling out of it. And, obviously I should have just not been reading that headline and holding on to that stock.
Yeah, I'm the same way. If I'm invested in something, I'm trying not to watch every tick, because the only thing that's going to happen is I'm going to screw that up.
You do. Long-term investing and trading are two different animals. As a trader,
100%.
I'm watching the ticks. As a trader, I'm trading the headlines. As a trader, I'm taking advantage of pricing inefficiencies. As a long-term investor, I'm trying to buy good companies with good stories that I believe in. And that's the tricky part. And, separating those two things is a difficult thing to do. And, if you figure it out, let me know. Because I've always struggled with that.
Will do. Well, I got to say, Dennis, you have an amazing trader's journey. Thank you very much for sharing that with us today. And viewers, I really hope that you'll join us for the next episode of A Trader's Journey.